Welcome, StockCharts TV viewers, and thank you very much for joining us tonight. Alex Cole and I are here not to give you any stock tips or our prognostication, best guess scenario about where the markets are headed in the next few months or few years even. Instead, we're going to talk about process and tools that should change your approach to investing. Hopefully, these evergreen lessons will find their way into your practice. So let's relax. Right? It's 5 o'clock. Markets are closed. Grab a pen and notebook, and let's dive into Embracing Volatility, this exclusive special for StockCharts TV.
So this is one of my favorite quotes. I know you've heard it before, and we both believe in the power of routine. So Aristotle said, we are what we repeatedly do. And I think that's really important. That's what we need to do when we look at approaching the markets, is get a system in place that we can rely on, that we trust, and that gives us an intelligent framework within which to invest. So an interesting anecdote at the moment, unbelievably, my son is actually today, he just passed his driver's test in school, the academic portion of it. So he took his test and he passed, but he's learning to drive. And that made me think that when he's out there on the road, I'm going to want him to follow a set of protocols to make sure that he's as safe as possible. You know, for learning to drive, that might be something like making sure you fasten your seatbelt, make sure you start with your foot on the brake, check your mirrors repeatedly, signal before you pull off, and then of course engage your gear and drive off into the road. And if you follow a process systematically every time, hopefully you will do the right thing more often than not. And the same can be said with technical analysis. And when we learn technical analysis, there are so many topics that we can dive into, from Dow theory, moving averages, pattern analysis, trend lines, you name it. But we have to get out of that study a process that we feel comfortable following every time. And then if we have a repeatable process, then that takes away the analysis paralysis, it takes away the doubt, and it gives us something that we can believe in when the markets are very volatile, which of course they've been over the last few months.
Now, just to continue with that metaphor for a minute, one of the reasons that Alex and I are such firm believers in technical analysis is that you can develop a very routine or disciplined objective approach to what's happening in the markets, right? Now, when I graduated from the MBA program at the Kelley School of Business, it was all based around accounting and fundamentals of security selection and analysis. And that introduces a ton of subjectivity, right? If you look at a DCF model, or you're trying to understand growth of a new startup, you're introducing a whole lot of variables that we know drive long-term trends. We know that the fundamentals are very important, but we don't know which ones and at what time, right? Are we talking about price to earnings or price to book? Are we talking about debt to equity ratios, free cash flow, margin expansion, or just simply user growth? Right? All of those fundamental principles are important, but when we're being objective investors, using a technical checklist is the best way to reduce our emotional inputs. And so from whether you're a beginner investor, you're just starting to learn how to trade, or you're a very sophisticated institutional money manager, think about trend following like this. A Formula One driver doesn't have to know all of the particulars of an internal combustion engine or fluid dynamics. They don't have to be a PhD in physics. They need to drive the car. And you yourself don't need to know all of the complexity of the fundamental side of the securities that you're trading. You need to understand the technical picture. So, Professor Cole, let's walk through what a responsible approach to trend identification looks like.
Absolutely. And it takes the form of walking through situations on a chart that will add a weight of the evidence kind of thing to your decision making, and you want to line them all up to know that you've stacked the odds in your favor. Now, where you might start is just simply looking at the chart and trying to identify whether it's moving in any discernible direction, and you'll do that by looking for higher highs and higher lows. And if you can get a sense of where price is headed and you can trade in that direction, then you're going to profit on that price move. And of course, it's simple, but not easy. So what we want to do next is then automate the process so that we aren't making those decisions subjectively. So you could look at something like Donchian channels. If you're familiar with the story of the turtle traders and Richard Dennis, Donchian channels were their main way of entering a trade. And what Donchian channels does is just look back over a certain time frame and ask, is price right now the high of that period or the low of that period? And if it is, then it puts a line at that level. So as you can see, price making new highs, that red line will rise as price moves higher, and the green line, the lows, will rise as well as price sets new lows. And then from there, you can add a number of things to determine whether or not you're identifying a trend or a new trend. You could look at Bollinger Bands. We know, if we've studied technical analysis, there are several ways to interpret and read Bollinger Bands, but one of them is that when the bands narrow, we expect a break, and if the break comes, we will trade in the direction of that break. So if the bands are narrowing, as they are perhaps at the beginning of the chart here, we might look for a break to see in which direction to trade. And then, of course, moving averages. I don't know of really anyone that doesn't have a moving average on the chart. And when I worked at Bloomberg, we used to consider moving averages not even representative of core technical analysis because it's so prevalent that we just assume that they are on people's charts. And so, but it's going to give you an indication. It's inherently bullish, for example, if price is above a moving average, because what we're saying then with some certainty is that price is trading higher than it has over a historical period relative to its average. So that gives you a sense of trend. You want to probably look at volume as a confirmatory indicator. Remember, what you're seeing in price, you want to know if it's backed up by market participation. Is the market taking part in that move that you see in price? So you want to see fairly healthy volume on something that you're seeing in the price action. And then, of course, you could throw something else on the chart to add weight to your decision, perhaps something like the MACD, which of course looks at the difference between two exponential moving averages to see if prices in the short term are moving faster than they were in the longer term. And of course, when the MACD and its signal line are above zero, that could be considered bullish. When MACD crosses above its signal, that could be bullish. So you're looking over towards the left side of the chart where we're highlighting here, and you're starting to feel confident that you're recognizing the beginnings of a new trend in the up direction. Somewhere over there on that left side, you've got Donchian channel new highs, you've got price breaking out of Bollinger Bands, you've got price above its moving average, you've got pretty healthy volume, you've got MACD above zero. So you're able to say at this point, I think we're starting a new trend in the up direction.
Now, the difficulty with technical analysis, and one of the problems that we have all struggled with, is that as you develop your approach and you have your rules-based checklist, right? You're trying to be objective about identifying the start and the end of trends that you want to participate in. The more tools you add to the chart, the more complexity you introduce. You can introduce analysis paralysis, right? So today's talk, we're discussing what it means to actually be a disciplined investor. And technical analysis falls into those same behavioral pitfalls that a lot of our fundamental peers do. You're introducing subjectivity, and frankly, we're starting to obscure the price panel in this chart. Now, we know that that's a problem, but we really want to preserve that weight of the evidence. We want all of the information. We just want it computed in the back end and pulled off of our chart, represented in a much more simple way. So Alex, let's talk a little bit about go-no-go trend.
Yeah, so the trend chart, GoNoGo trend, allows us to keep all of that information that we found most valuable over the years and most sort of tried and tested when working with clients throughout the industry. But it just combines in the background to paint the price bar based on the color, based on the strength of the trend, I should say. So as you're looking at this chart, our go colors are blue and aqua, meaning that the conditions are a go. We're in an upward moving trend. And as long as you see those blue and aqua colors, aqua obviously represents a little bit of weakness. It's the weaker form of the go trend, but those are our go colors. The no-go trend, a move to the downside, is represented by pink and purple bars, with pink being the weaker form and purple being the strong form of a no-go trend. And if you see there in the middle of the chart, you perhaps can see a couple of amber bars. Those are our neutral reading, where we don't see enough indicators on either side to be able to specifically tell us trend direction. So we paint those bars amber, and we call those the go fish bars. So we've got the go trend, we've got no go trend, and we've got go fish. And of course, if you've heard our presentations, you'll know that's because we love the Jesse Livermore quote, that says that there's a time to go long, a time to go short, and a time to go fishing. So we often see those amber bars in transitionary periods between trends or in real weakness within trend. We might see a little bit of neutrality coming in the form of those amber bars where the market's really telling you just go fishing and wait until you see what direction we're going to go in next.
Now, what's so powerful to me about the GoNoGo trend tool is that we're combining many more indicators than what we showed in that relatively simplistic checklist of Donchian moving averages, Bollinger Bands, etc. What we want to do is collect the full weight of the evidence. We want as many technical indicators at our side as possible, but we want to simplify our charts because from better charts come better decisions. And we know that in the practice of trading and investing, you've got a lot of additional decisions to make about position size. And so being able to identify those trends simply and easily is the main goal. Now, we're so proud of this work. The first thing that we want everybody to do is right after this session, go download the free GoNoGo starter pack. So that's just the GoNoGo trend. You can use that right on your ACP charts in StockCharts.com. It's a very simple install and it's completely free. The reason we want to give that away is that Alex and I have spent most of our careers working with really expert institutional fund managers, research analysts, and buy-side traders. And we've found that a lot of the tools that they use should be available to all of the individual and self-directed traders out there. So we've made this available in StockCharts. All we would ask is that download that for free and then shoot us an email, info@gonogocharts.com. Let us know what you're trading, what your time period is, how it's working for you, if you found that you're a little more disciplined in exiting those trades. So Alex, what are we really looking to do as traders and investors?
Well, clearly, we want to participate in trends, not try to anticipate them. We talk about not never predicting, but reacting responsibly to what the market gives you. And so, if you do that, then you can remove that doubt, confusion, or uncertainty and remain objective. And the way you remain objective is by sticking to the rules, sticking to that process that we talked about earlier on. It allows you to then take part in the market, but without getting emotionally involved.
Now, the great David Keller has done a lot of research on behavioral economics and some of these emotional drivers that get in our way as traders and investors. I wanted to pull out a little bit of the quantitative evidence. So Professor Terence Odian is at Berkeley Haas School of Business, and he's written extensively to provide statistical proof to a lot of the behavioral economic theories, things that Kahneman and Tversky were publishing in the 70s, and many Nobel laureates since then who've been awarded prizes based on these concepts. So taking a look at 360,000 day traders over a 15-year period, what Terence Odian and his fellow authors found was that these concepts are very simple, but they are not easy to execute, and it's behavior that gets in the way. So I've got a couple questions for all of you. You can shout them out at home. Don't worry. No one can hear you. Out of these 360,000 day traders, what percentage do you think lost money over the long run? Take a minute. It's a multiple choice question. The answer is E. 87% of those 360,000 traders lost money over the long run, which is less than 1/3 of 1%. Right? It's very difficult to be consistently profitable. And here we're looking at day trader results. There are lots of excellent academic papers that prove that 88% of institutional portfolio managers fail to beat their benchmark. This is not a simple task. If it was, there wouldn't be such an interesting stock market, and we wouldn't all be here trying to learn and improve our process. All right, a little bit more data, this time from the currency trading side, looking at individual currency pair trades over 43 million trades. Again, this research comes from Terence Odian. Highly recommend you go check out some of his books and YouTube lectures that are available widely. The question now is, what percentage of their trades were profitable? Meaning, did they get their directional bet correct? We just heard that 87% failed to make money. How would you answer this one? Well, the correct answer is that over 50% of their trades were profitable, meaning they had an edge, right? They were better than a coin toss. They had some toolkit that helped them understand the directionality, and they were placing their trades in the right direction. So the average retail trader has a win-loss ratio greater than 50%. The percentage of their winning trades outpaces their losers. So they have that edge to be right, more than wrong. But why do so many of them lose money? Well, the answer comes down to these behavioral impulses, right? Having the edge to find winning trades is one part, but the discipline of money management is so crucial, right? We've learned from David Ricardo in the 16th century these maxims like let your winners run, cut your losers short. Right? That's very easy for anybody to stand up and say, but doing that in real time in practice is very, very difficult. And obviously, removing complexity from your charts helps you follow your rules, stick with your system, and avoid some of these behavioral pitfalls. So I'm going to get mathematical on you for just a minute here. We're going to talk about the expectancy formula. Have you ever had a trade that then became an investment? Meaning you had such high conviction in this security that you picked that even when it started to move against you, you needed to stay with it. You knew it was going to come back in your favor. It was going to turn around. Well, if it's down 5, 10, 15, 25, 40%, right? This is a serious drag on your portfolio. These kinds of losses add up. And as trend followers, the good news is you don't have to be right all of the time. And in fact, recognizing that you're not going to be right all the time is a critical element of being a disciplined investor. So right here along this efficient frontier, we have all of the trading systems that are going to break even. It's just a combination of the percentage of winning trades and then the profit ratio of those trades. So right here, we're at 50%, right? That's just a coin flip. Throw a dart at a list of stocks, buy whatever the dart hits. But if you can be disciplined in how you control risk, right, you can still be profitable over time. So here at a 2-to-1 profit ratio, you can still be profitable in this trading system. Guys like Paul Tudor Jones live somewhere up here where they're totally fine to be wrong 4 out of 5 times. But when they find that trending security, when they have that winning trade, when things are working to their advantage, they can play much more aggressively. They can press their bets into those trends and make sure that they get those outsized gains. Just think about, Major League Baseball. If you bat 300, that means you're striking out 70% of the time, and you get into the Hall of Fame. So don't get wrapped around the axle about how often you are right. Right? We're here to make money, not to be right. And so when we come down to disciplined trading, we have to look at not just our edge and our strategy, which GoNoGo charts will help you do, but also the discipline to stick with trades, stick with trends that are working, and cut those losers short.
So this has to be one of our favorite quotes. We use it all the time. And it really hits home how important the market price for any security is. And if you read it with us, ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And this consensus is revealed by analyzing price. So having said everything that we've said thus far, we want to keep the focus on price. Price is what pays. Price is most important. Price is never restated. Price is not an estimate. You've heard all of those things, and it's true. The market agrees upon what something is worth, and that is the price that they're prepared to pay for it. And so that price, as chartists, as technical analysts, that's what we need to focus on the most when we look at our charts.
And how many pundits and talking heads on financial news media have you heard say, oh, bad news is good news, right? We get a poor jobs number, then the Fed might not hike rates so much. And then if there's more liquidity in the market, that's going to be good for equities. My goodness, what kind of mind games do we want to play in trying to predict where the market's headed? Instead, we want to react responsibly to what the market is giving us. So just a quick review. And for those of you who have been on the GoNoGo show every week, Thursday afternoons, a lot of this is going to be familiar. But for anybody who's new to this concept, we're just looking at these colors to represent that weight of the evidence. So Alex, let's walk through the Facebook dilemma. Let's take a look at a chart of Meta using a responsible rules-based approach and a multi-touch point checklist.
Yeah, I mean, and this is the problem, right? And this is something that I've taken from a chart that I was looking at with somebody the other week, where it's a sensible process. You've got RSI, one of the most used indicators on the top. You've got Bollinger Bands, and you've got some moving averages. You've got Donchian channels, price channels in that price panel. And you've got a couple of other things on here. The ADX indicator with DMI and plus DMI and minus DMI, giving you a sense of trend, some other things. And this is the chart we're looking at, but it's, for me anyway, becomes hard to quickly see what's happening with price. Where are the important levels? Are we in a strong trend in whichever direction? You'll see in that second panel that price can get so small that it becomes hard to really understand what you're looking at. And now that doesn't mean we're not here to say that a process like this is no good. This is a very good, sensible, disciplined checklist for understanding and using technical analysis. And if this is your chart and you understand it, that's fantastic. But the problem is, of course, in explaining it. If you're a sell side research, explaining it to the buy side. If you find yourself getting overwhelmed, if you find yourself having any kind of confusion or doubt, then look to simplifying your charts as a possible solution. So if we move on to the next chart, I think we're going to see Meta again, but with the GoNoGo chart. Now, believe it or not, this is the same period of data. This is the same price action. And the downtrend that we've been in since the beginning of the year just is undeniable, and it sort of explodes off the screen because we don't have anything else on the chart at this point that can cloud or overwhelm or complicate what we are looking at in price. The trend is a no-go. It has been a no-go since the beginning of the year. We've seen a mixture of the pink bars and the strong purple bars, and you can see how it rolled out of that go trend with some amber go fish bars expressing that neutrality, and we've been in a no-go trend ever since.
Now, real quick, I want to pop back to this chart. When I first joined the CMT Association over a decade ago, Ralph Acampora, one of the founders of the organization, told a story about starting a new job as the chief strategist for a firm, and he walked around the trading floor, just getting to know everybody, meet folks, and he came across a trader, who had 6 vertical monitors and 20 panels under each chart and lines going everywhere, and every indicator you've ever heard of is on his screen. And Ralph leans over and he says, "Wow, son, I've never seen technical analysis done like that. What are you looking for?" And the kid looked up at him and he said, "Please don't tell my boss. I have no idea what I'm doing, but he thinks I'm a genius." So I want to just reach out to all of you who are drawn to technical analysis because of its sophistication, right? Finance is so complex, and we've got all of these mathematical tools, and we, kings of the universe, are the only ones who can understand what we're doing. I guess if that's your objective, to look really sophisticated, then by all means, add as much as you possibly can to your chart. If your objective is to capture market trends and be profitable in your trading account, then simplifying your process is a much better way to hold on to trends that are working and get out of trends that stop working. All right, moving on. The next concept that we have to cover is that technical indicators should work over any time frame. We've got to give a shout out to the OG technical analyst, Mr. Charles H. Dow. Certainly in the West, he's sort of the father of modern technical analysis. He's the founder of the Wall Street Journal, the Dow Jones Indices. He was also a very accomplished nautical person. Trying to explain the complexity of the markets, he used this metaphor of the oceans. And he said that markets can move over multiple time frames. We can see trends over multiple periodicities. So we talked about the primary trend being like the tides of the ocean. This is the long-term secular trend. This is the underlying bias of the market. And it's largely driven by expanding or contracting GDP. It's driven by the fundamentals of the securities that we're investing in, macroeconomics, and it's largely unflappable towards human emotion. But we know that the market doesn't just go up in a straight line or go down in a straight line, right? Price fluctuates above and below that primary trend. So Charles Dow identified the secondary period, and he talked about that as like the waves on of the ocean, and that it's largely driven by fundamentals and macro drivers, but also the opinions about those pieces of information. Now, technical analysts have made a lot of hay in this secondary period because we can look for mean reversion towards the primary trend. We can see areas of emotional extreme where price becomes depressed or elevated relative to that primary trend. And then, of course, he identified the minor period or that tertiary trend, which is like the ripples on the surface of the water. And what he's talking about in those very short-term time periods is something that's purely sentiment driven. This is just human emotion and the reactions to the news of the day. So whatever your time period is, and Alex and I are not here to tell you you should only trade long-term or weekly charts are the best or a 5-minute on the E-mini is what works you can use any time frame that suits your risk tolerance and your trading personality. What we recommend is that at any time period, you also zoom out and reflect on those larger periodicities. Look at multiple time frames in order to better structure your trades, understanding that underlying bias. There's a great book out there by our friend Brian Shannon, who's a CMT charter holder. Give him a follow on Twitter if you're there at Alpha Trends. But talking about how to use multiple time frame approaches in trading. So Alex, let's go back to the GoNoGo chart. Let's look at weekly data on the S&P 500. Where are we at?
Yeah, so real quick, we'll run through these slides, but on the weekly chart, you can see that we are still in a week no-go, even though we've had a strong rally over the last few weeks. We are in a week no-go if the larger time frame that you look at is a weekly chart. If you dive down from there into a daily, you can see that we've had a really strong move that's pushed us into a go trend on the daily chart. So remember, we talk a lot in our show about relief rallies and keeping things in context. We've seen a strong move to the upside, and we will look for the weekly chart over the next couple of weeks to try to confirm that. Because you could be working with somebody on a shorter time frame chart. Imagine if you're working with a portfolio manager, or if you're a money manager and you've got a trader who's entering positions for you, they might be going down in time frame from here to look at something like a 60-minute chart, or even faster moving, of course. And if your larger time frame as a trader is the daily chart, and you know you're in a go trend, then you might be looking for go opportunities on the smaller time frame chart to enter a position. And so on the 60-minute chart here, you can see we had a go trend several days ago that has created new highs on this time frame. So as Tyler said, the beauty of technical analysis is how fractal it is and how it should work over different time frames.
Absolutely. So, word to the wise, you have to look at multiple time frames. We also know that looking across the asset classes has a ton of information. Even if you're not a currency trader, or you're not speculating in commodities, and you perhaps only trade equities, there's a lot to be learned from the intermarket relationships. We've worked with John Murphy, CMT, a wonderful StockCharts contributor, but also follow the works of folks like Marcos Katsanos, who've built upon John Murphy's intermarket approach to help quantify the correlations between asset classes and really understand that top-down approach. So between the asset classes, that intermarket understanding, right now, as we're presenting this on November 16th, we're at a major rotation in the nature and the environment that we're trading in, and we can get a sense of that by looking across the asset classes. So Alex, why don't you take us on a little round robin on this multi-chart layout?
This is really exciting time. Like you said, we are seeing changes, and we'll see how long they can persist. But if you go just quickly round the charts here, you can see a strong go in equities. We're seeing strong blue go bars at new intermediate highs. US Treasuries, which have been really struggling, are still in a no-go trend, but you can see how that trend has weakened and is painting pink bars. You look across then at US oil, which of course was the big performer throughout the first half of the year and then corrected all summer, back trying to maintain a go trend. If you can see the very right of that chart, is peeking into an amber go fish at the moment. So a little bit of neutrality, we'll see what happens there. Bitcoin keeps trying, keeps failing. We saw that strong move down about a week or so ago. We're at new lows now on strong purple no-go bars on Bitcoin. Moving across to gold, gold's been interesting, Tyler, this week, because we've been talking about how gold has not been the flight to safety that everybody thought it would in this rising rate environment. And look now, as all of a sudden equities start to do better and rates cool off and we think things are a little bit better, look at gold popping on the right side of the chart. So gold entering a strong go trend as well. And the dollar, of course, having held up its end of the bargain in the go trend for so long, rolled over really hard and fast over the last week or so. It is in a strong no-go now.
So understanding that macro landscape, understanding that the treasury bond prices move inverse to rates in this rising rate environment, in a strong US dollar environment, we've had less appetite for risk assets like cryptocurrencies and certainly equities as well. What we do as GoNoGo Charts co-founders, we publish a lot of research. In fact, the business started strictly with our institutional clients, taking this top-down approach using GoNoGo Charts to help explain what we're seeing in terms of a trend perspective from that macro basis. So starting with the asset classes, working into the sector groups of the equity indices, and then down to individual securities. We publish that every Monday morning. And then we also, because we believe in a disciplined routine, just like those student drivers, every Saturday morning we send out a chart pack that just reviews all of the global asset classes and indices to get an understanding of the longer term picture and help develop a trade plan from that. So launch conditions goes out on Saturday, sort of preview the world landscape, and then flight path coming out every Monday morning. If you're interested in those, you can find subscription information right at GoNoGoCharts.com. Now, the interesting thing for us in publishing this research is that we can see those rotations as they're happening in real time. And so what we publish in Flight Path really informs a lot of what we do and share with our clients. At this point, I want to congratulate all of you for making it to the 50-yard line. We're halfway through tonight's presentation. If you're interested in grabbing this slide deck, please send us an email, info@GoNoGoCharts.com. Happy to share that with everybody who's watching, either on StockCharts TV or on YouTube. But now, take another sip of your coffee. Let's dive into the second half of tonight's presentation that really focuses on the concept of volatility compression, right? So when we're talking about the complete GoNoGo chart, we're looking not just at the price panel, everything that we've been discussing so far, the blend of technical indicators that gives us an objective approach to understanding market trends, but also in this lower panel, what we're looking at are additional confirmatory indicators like momentum, volume, and volatility. So Alex, let's dive in first and foremost to the concept of momentum.
Yeah, I'm so excited for this second half because we're really going to get deep into that idea of how to find those exciting opportunities that lead to the beginning of market trends. And so let's quickly run through momentum. Momentum is the sort of next piece that you might turn to as a technician when you're trying to understand price action. And momentum gives you valuable information about price strength, right? We talk about identifying sort of price velocity. You're trying to understand how fast something is moving in a certain direction. And of course, we have lots of these that provide information that's very valuable, but you can quickly see that if you add 3 or 4 more panels to your chart and you add that to what we had at the beginning, all of a sudden you've got an even more complicated and overwhelming chart. So what we did was we wanted to do the same thing, which is take that information that we found to be valuable, but combine it and blend it into one oscillator that gives us that information, but keeps the chart simple and keeps the focus on the price panel. So you can still use the GoNoGo oscillator just as you would any traditional oscillator. If you're used to using something like RSI, think about identifying extremes of overbought and oversold. When the oscillator makes a peak or a trough, that will line up with a peak or a trough in price. You can also quickly identify momentum divergence, which is an incredibly powerful concept. If you've got price making a higher high, but your oscillator not confirming with a higher high, then that's bearish divergence. If you have price making a lower low and the oscillator, though, not confirming because it's making a higher low, then you've got bullish price divergence with the momentum oscillator. And that's, of course, very valuable information. And of course, we've wanted to include the complete technical picture into this one chart. So volume is incorporated into the oscillator. When the oscillator changes color, something significant is happening with volume. So when the oscillator goes from that aqua to a darker blue, we know that volume has increased. Volume is higher than its average volume over the last set period. So you can see there when that no-go really starts to fall, the price starts to fall into that no-go, making lower lows and lower highs, you've got oscillator telling you that volume is confirming by being heavier than usual. So we wanted to incorporate that into the oscillator as well. But that's the traditional way to use the GoNoGo oscillator.
Now, the thing that really sets GoNoGo oscillator apart from all of the others is the idea of using momentum while a security is in trend. And I know Alex has done a ton of research on the works of folks like Connie Brown and many others, looking at how an oscillator might oscillate during a trending market. Now, I want to talk to you about how I learned momentum, and it comes again from Ralph Acampora. and he explains everything in terms of baseball, right? He's from the Bronx. Everything's baseball with these guys. And he says, Tyler, think about momentum as a ball in your glove. And when you throw it, it's going to be fastest the moment that it leaves your glove. It's going to reach the apex, as high as you can throw it. It's going to slow down, and then it's going to come back down to your glove. You can throw it again, it slows down, right? The rate of change decelerates is the mathematical way to say that. And so when we're looking at the GoNoGo oscillator, we needed an objective level of support for momentum to come back to a neutral level, or for that baseball to come back to our glove. Now, the game of catch is still on if we find support at the zero line. So in 2020 and 2021, I'm sure you've all seen the TikTok traders that talked about buying the dip, right? BTFD, bro. It's so simple. Every time price contracts, it's a buying opportunity. Well, as trend followers, we really need to understand those buyable dips, right? In order to stay patiently with a trend that has a long duration, or maybe even to pyramid into our positions, to size up the scale of that trade to make sure that we're getting those outsized gains. So every time the GoNoGo oscillator comes back to the zero line and finds support, right? So all of those momentum indicators blended in the background, they're in their neutral territory. They don't move to oversold, right? That would be a threat to the uptrend, to the go trend, if we've got enthusiastic selling. Instead, they stop here at the zero line and find support again. What we're looking at is a resurgence of momentum in the direction of the trend. And in this example of Valero, we can see that in all of these price contractions, we found support with the oscillator at the zero line. Alex, anything else that you wanted to add to that momentum oscillator at the zero line?
No, that really we believe and we find is the little bit that hopefully makes the GoNoGo oscillator add some value, because it's objective, not as you would find when you're trying to find those ranges of trading, like you said. The oscillator trading in a range when in trend is very difficult to be objective.
And so the next step that we took, right, using data visualization to make these things as simple to read as possible, to help you take action more quickly, is to pull out these opportunities where trend is in place and we see a momentum resurgence in the direction of that trend. We've got two forms of icons on this chart. The first are those trend continuation icons, right? Just what we were talking about. We're going to look at some examples where you'll see this in a no-go trend. If you trade to the short side, you can look at the exact same tools in reverse. But right now, let's just stick with the go trend, where we see momentum coming back in the direction, finding support at zero. We're going to highlight those opportunities with these green circles. The other way to use the GoNoGo oscillator and to call out these moments with some data visualization is with these red counter trend correction arrows. So in the intermediate time period, when the oscillator reaches an extreme and then comes back, we know that price is going to have difficulty accelerating to the upside. We know that this is an intermediate term high based on the deceleration of momentum. So if you are looking for an opportunity to get out of one trade, maybe you need to deploy capital to another security that's trending higher on a relative basis, or maybe your kid's going off to college and you have to close out some positions. Whatever it may be, these are opportunities for us to identify an intermediate high in the trend. Now, the most important, the piece de la resistance for today's session, we're here to talk about how we can embrace volatility. And this is that crucial fourth piece of the GoNoGo chart. Alex, talk to us a little bit about volatility compression.
Yeah, we really wanted to touch on this in this presentation because we've heard so many times over the summer, how can you survive in such volatile markets, or it's impossible to trade in these volatile times. And I think what we want to do is understand that volatility can lead to opportunities as trend followers to either participate in surging trends or to identify the beginnings of a new trend. So as technicians who follow trends, and we know that being in the right side of the trend is the way to consistently make money, we want to find those areas of increased volatility that can kickstart those larger moves. And so volatility compression occurs at important points. We know this, right? When perhaps you're at a market top, then we see price consolidate and volatility compress. Or after a big run, we see profit taking and volatility will compress. We also know that periods of low volatility can lead to periods of high volatility. So we want to take those opportunities. And what we want to do then really is look for volatility squeezes. Now, if you're familiar with technical analysis, you might well have heard of this idea. People look for Bollinger Band squeezes, Keltner Band squeezes. A lot of people combine these ideas to look for situations where you can use the interplay between different volatility indicators like Bollinger and Keltner together to identify squeezes. But if you boil it down, it's looking for a narrowing of the bands, because these bands identify wide swings or ranges of trading. And when those bands narrow, it tells us that price is moving in sort of smaller areas, or is moving with much less volatility. So how do you do that? Let's take the Bollinger Band example. Bollinger Bands are fantastic. And you know, without the work of some of these giants that have come before, right, we wouldn't be even in this industry doing what we're trying to do now. So Bollinger Bands, when you look at it, what you're trying to identify when looking for a squeeze is a narrowing of the bands. If you know Bollinger Bands, there are two ways to trade it. And the way that gets us excited as trend followers is looking for a break out of narrow bands, because that tells us we've had compressed volatility, and then you would trade the direction of the break. So the way to look at that is the bottom panel here, which is our bandwidth indicator. And bandwidth will allow us to see how relatively wide those bands are. So if you look back through the chart, where have the narrow bands been? You can see the lows. You can try to get a sense of where the bands are lower than they have been, and you can visually try to identify that. And so towards the right side of that chart, if you go back to that chart for 1 second, towards the right side there, you can see those bands really narrow, and the Bollinger bandwidth makes a slightly lower low. I think if you can pull that out visually, and then you can expect price as it breaks to the upside then to move higher, which indeed it does. Another example then is the chart of the dollar ETF UUP. And you can look at the chart and you can look for those areas of compressed volatility. And of course, you're trying to use your eyes to sort of look at the right side now of the chart and say, is this band narrow enough to give me that situation that I'm looking for? We see some lows in the bandwidth, but the right side of the chart where price rolled over after the top, was that low enough? Was that bandwidth narrow enough for us to really sort of be confident trading the direction of the break? Well, that's what we're trying to identify, those situations. And of course, you know now where we're going with this, that if you add this to your chart, you've added another panel, because that bandwidth is very important to identify those situations. You can't do it on your price panel because price is so small, I can't even see where the bands are. I know they're on there, but the bandwidth panel you add, and now you are adding to your problem chart. So what we want to do then is find that situation using something that doesn't overcomplicate or overwhelm our chart. And that's the go-no-go squeeze. Now, in the same way that we know how important the zero line is, the zero line gives us that objective level of support or resistance when in trend. We know, therefore, that if the oscillator remains at zero for an extended period of time, all of our inputs to our momentum indicator are stuck in a neutral zone, right? They're all stuck in neutral territory. So for every bar that the oscillator stays at zero, we aren't seeing directional momentum. And so what we do is we allow the grid of the go-no-go squeeze to climb. That amber grid climbs to its max for every bar that the oscillator stays at zero. We have no directional momentum. There's a real tug of war going on between the bulls and the bears, and we wait for that break out of the squeeze.
Now, we know that technical analysis is a powerful tool to visualize the behavior of investors. So just think about, as we're moving from left to right, we've got positive momentum. We're in a go trend. It comes back and finds support at zero. We've got heavy volume to the upside. And then we come back to zero and we've stagnated, right? There's a tug of war happening between buyers and sellers. The range of price action narrows, the volatility stagnates, and we have this compression. In this example, we've got a trend continuation, a volatility squeeze that leads to trend continuation. which in an uptrend, all else being equal, that makes sense. Buyers regained control, and we move to the upside. Volume picks up as price makes these new highs. Again, we don't know in advance which way the volatility squeeze is going to break, but we can react responsibly to the information that the market is giving us. And it removes all of the subjectivity of using other volatility squeeze tools to decide, is this a significant break? Was that compressed enough to be useful in trading the direction of the break? Alex, let's go through a couple of examples, international seaways being the first. Let's talk about a trend continuation in the volatility squeeze.
Yeah, so these are now the go-no-go charts of those two examples that we had on the screen before. We've got the international seaways chart where you saw the narrow bands in the middle of the chart on the Bollinger Bands. And there's the squeeze. You saw that squeeze build as price corrected against the trend, causing the oscillator to fall to the zero line and stay there. You can see a couple of things happening here. You can see weakness in the go trend with the aqua bars. You see that it started to struggle after that counter trend correction arrow, which pulls out those sort of intermediate highs. And then we will look to the oscillator to see, is this now going to be something that ends the trend, or is the oscillator going to find support and ultimately break out of the squeeze in the direction of the trend? And of course, you can see that it broke out of the squeeze in the direction of the trend. Go trend continues, and we move to significantly higher highs. Now we're the right side of the chart. Where are we? We're right back at that zero line, so an important moment again. And then the next example then is the chart of UUP. And UUP, if you remember, on that chart that had everything on it, it was very difficult to know where was that rollover or that top going to be, and were those bands narrow enough? Well, we're not looking necessarily here at anything other than a break of the squeeze. And you can see how price consolidated from the high, moved mostly sideways, and the oscillator really fell to the zero line for an extended period of time. And then as it breaks out of that squeeze significantly into negative territory with some high volume, we see a amber bar telling us that the go trend is really in trouble. The oscillator comes back, tests the zero line, and then moves back into negative territory as the no-go takes hold, and it rolls over very quickly. And we've moved quite a bit lower on the dollar over the last week.
So two things to point out. One, the concept of polarity, right? What was support becomes resistance. Once we break to the downside on the GoNoGo oscillator, now this zero line is an area of resistance for momentum. It struggled to get above the zero line back into positive territory. So it's a retest and rejection back into the negative territory. The other thing to point out on this chart of international seaways, right? If you're fans of Edwards and McGee and classical price pattern analysis, you've got enough clean space up here to be able to see that this is a trend channel continuation. You look for the flags, the pennants. Very simple to draw your trend lines or to pick out those price patterns in a chart that doesn't get clouded with a lot of other indicators. I brought back this UUP chart just to understand that in the scenario where you are the trader, we never know what's going to happen beyond the right side of the chart. So you have to react in real time. And if 10 out of your 12 or 9 out of your 12 indicators are telling you that it's a no-go, that the trend is over, do you anchor to those three, right, that are telling you what you want to hear, that you think this trend is going to continue? Or can you simplify your analysis? Can you avoid that analysis paralysis and simply exit the trade as the go trend ends and we're rejected back below zero? That's the whole goal of these charts, and the goal of tonight's presentation is to help you improve your investment decision making and improve your disciplined rule following approach, right? Back to that expectancy formula. The only way that we're going to be profitable over time is if we react responsibly to what the market is giving us. So let's go through a couple more examples, Alex. Here's the chart of Apple, one of the favorites.
Yeah, this is just another example of a squeeze being broken. This was from the summer where the Apple was really sort of leading the market, and we saw how exactly that. We saw a bottoming formation over the summer. You can see bullish divergence there with the oscillator making higher lows when the price made lower lows. And so that is something to pay attention to. And then, of course, the oscillator gets stuck at the zero line, and we see a max squeeze build. And this is that situation you were talking about before, where it could be a trend continuation or it could be a reversal. In this case, we've been in a no-go trend. What would we expect? All else being equal, we'd expect the zero line to be resistance. and it wasn't. The squeeze was broken to the upside. The GoNoGo trend indicator paints some amber bars of uncertainty, and then the Go trend takes hold and we move higher. So just the example there of it in the other direction.
And just real quick, for everybody who does trade to the short side, one thing to point out were those icons in a no-go trend. We're going to use these tools in the exact same way, just in reverse. So where we have an extreme in the GoNoGo oscillator, when it leaves that oversold extreme, we see a counter trend correction arrow, this green triangle. And then where we see momentum picking up in the direction of the trend, a resurgence of downside, negative bearish momentum within the no-go trend, we get these red circles. Those are our trend continuation icons. So, as a short trader, potentially you're covering your shorts at periods of counter trend correction, and then really leaning into those downside plays where we have trend continuation icons. So just wanted to point that out for those who do trade to the short side. Alex, let's go through one more example of Netflix.
This is a favorite to be put on here just because of the multiple squeezes on this chart. This has been a fascinating chart since the beginning of the year because people were sort of kept saying, how low can this go? These gaps are huge. Surely we should fade those moves. And really, we don't know. Like you said, we don't know what's going to happen on the right side of the chart. And also, don't let the bottom or the top of the chart tell you that it's support or resistance, right? You can always move lower. You can always move higher. So Netflix breaking out of successive squeezes to the downside when in that no-go trend, starting on the left side, we got a break of a max squeeze, no-go trend continuation before that big gap. The big gap happens. We get another break out of a max squeeze to the downside, no-go trend continuation icons as the oscillator provides resistance at the zero line. And then again, as it breaks through the zero to the downside one more time, we get another continuation icon before that big gap. And then you move to the right side of the chart. You're now wondering, okay, is this a base? Well, you're seeing the go-no-go trend start to paint some amber bars. The oscillator has risen to the zero line and got stuck there again. And this time you get a break out of a max squeeze on heavy volume to the upside. And so that tells us that for at least this period, this is a few months back, that the no-go trend has ended and we might move higher. And then, of course, the go trend comes into play over the next few months.
And Alex, I know we didn't annotate this chart, but notice how the break of that downward sloping trend line happens on trend change, right? Where we strike a go as we're breaking above the downward sloping trend channel for Netflix.
Yeah, we absolutely find anecdotally that color change on the trend indicator happens at significant points on the chart, whether that's a break of resistance horizontally, whether that's the break of a trend line, whether that's a right shoulder of a Head and Shoulders breaking the neckline. We do find that the color change happens at important moments, and that just adds weight to your opinion.
Absolutely. In our last couple of minutes, we want to just also mention that we send out premium research to our institutional subscribers, meaning that we're with them every day and can be with you as well. Just sending out information about trades that are coming to the end or perhaps reaching a trend continuation point. The GoNoGo squeeze is a major contributor to our premium research and one of the ways that we look for ideas. Now, the most important part of all of this is that to read a GoNoGo chart, there are only 3 questions that you need to answer. What color is the trend? Where is our oscillator at? Is there anything important happening at the zero line? So taking right from the premium research ideas, let's go through those 3 questions. You can shout them out at home. Right now, where is the trend for Spirit Airlines?
Yeah, and this one was came out when you see that max squeeze in the middle of the chart. Okay, remember we're trying to find those volatility surges, and this idea was because of that max squeeze broken to the downside, which gave us that trend continuation icon there in the middle of the chart that of course moved price lower. Now where are we? Well, we are now in a go trend, strong go. The oscillator is at zero. So is there anything important happening at the zero line? Absolutely. We're testing the zero line from above, which is what we're going to look for next. Does it find support? Is this new trend in the go direction going to persist? Well, the oscillator will need to stay above or at zero for us to have confidence in this new go trend.
All right, let's do another one. TIXT, TELUS International Technology Systems. Let's go through it together. Yep. Right now, where's the trend? We're in a strong no-go. Where is our oscillator? We're at -3. Anything happening at the zero line? Oscillator's in negative territory, but not yet even oversold on this strong no-go. And
Yep.
the point at which this idea came out to our subscribers was right at that max squeeze. And when the oscillator was below zero, we saw a real threat to the go trend. We ended up in this max squeeze, and of course resolved to the downside just ahead of the no-go trend conditions taking hold. And so the whole idea of cutting losses short, right? Let's say TELUS International blipped into negative territory and then took off. You can always buy back into that position. I know that's difficult to do emotionally, but imagine that we don't know what happens on the right side of the chart. We have to avoid the large losses. The way that we do that is identify a no-go trend as quickly as possible and get out of those long positions when that trend concludes. Thank you all very, very much for being here with us tonight. This has been a pleasure for Alex and I to talk to you about sort of the rules-based approach and how you can be a more disciplined investor, no matter what the market throws our way. If you want to use these tools yourself, obviously we talked about the GoNoGo free tool with the ACP plugin. You can also use the complete GoNoGo chart that we've been talking about here in the second half of tonight's presentation. It's right there in the ACP plugins. Simple to install, simple to use. Alex, let's finish off with just a couple more examples.
Yeah, so these now are as we speak. So these are from today. We always like to finish with some live ones. We don't know what's going to happen, as we've said many times on the right side of the chart, but we need to be ready for whatever indeed does take place. So where are we right now? If you're following along at home, this should be easy. We're in a strong go trend. The oscillator is at zero. And what's happening at the zero line that's important? Well, this presentation was focused around finding those reduced volatility situations where we can expect significant moves when we see the break of that max go-no-go squeeze. So we can see that we are in a max go-no-go squeeze for advanced auto parts on heavy volume. So we're looking for that to resolve in whichever direction. And then this last one is Cisco Corp, not Cisco Systems. This is our favorite toilet paper company or other maker of other utilities and common goods. And where are we? We're in a weak go on this one, but the oscillator again, of course, is at zero because we're trying to find these squeezes. We're saying that we're in a max go-no-go squeeze again. And what we like about these setups, if you're familiar with buying the dip or buying the pullback, is that when we have a trend identified, like we have in these last two charts and so many others that we've shown, the go trend is identified and we've seen a pullback, and that pullback coincides with reduced volatility, which leads to the oscillator getting stuck at zero and a max go-no-go squeeze forming. When that happens, it's like a buy the dip opportunity if it resolves back into positive territory. So go-no-go oscillator moved off here into positive territory, then we would say that that's an opportunity to participate in the trend.
Absolutely. Alex, as always, thank you so much for being here today and sharing some of these tools with everyone here on StockCharts TV, or if you're watching on YouTube, that's fantastic. If you'd like a copy of these slides, please shoot us an email, info@gonogocharts.com. Take care, be safe. We'll see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.